First one, market concentration. We started off with the definition. Market concentration occurs when a few equities hold a large percentage of the S&P 500, resulting in greater weights for those particular stocks. So why is this important? It's important because high market concentration means that leading stocks have a disproportionate impact on the S&P 500's performance, influencing both, obviously, the risk of that underlying, which is the benchmark, and the returns. So here you can see, I see you put together a little
pie chart.
Yeah, a little pie chart. So tell us what's in the pie chart.
So in the pie chart, you see the top 10 holdings of S&P 500 today, which consists of stocks like Apple, Microsoft, and they are only 5% of the stock. However, they hold currently in 2023 and 2024, they hold 32% of the weight. Whereas all the rest of the S&P 500 company, 490 of them, 95%, holds a total of 67.85. Think of this almost like wealth inequality. A small number of firms holds so much compared
to... It's kind of
wild
that 95% of the stocks make up 67%, and 5% of the stocks make up 33%.
Yep.
When you start to think about that, it really puts a very nice bow around market concentration. And like you wrote in here, we haven't had to experience any of the downside of that kind of risk. But if there was a downturn in the market and you saw some of these stocks, start to sell off, you would see, I think you'd see velocity of risk, maybe like we haven't seen before. It's not going to be about the zero DTEs. It's going to be about this concentration of risk. What you've done here is list out these large companies by weight. And what surprises me is that I didn't realize, well, I guess I should have realized that Microsoft was bigger than Apple. And I guess this is as of yesterday, right?
So these data we take from the SEC website. So these data are 2023. However, according to the newest one,
I got it.
Yeah.
Okay.
So the newest one should be similar because of the April 2024 version of the report is the same amount.
Got it. Okay. So it hasn't been updated as of yesterday. This is the end of the year type stuff, but it's close enough. These are your top 10 stocks.
Yep.
I don't think there'd be any surprises. Tony, any surprises in here for you?
No. Maybe Berkshire. I don't think I would have.
Mine would probably be Broadcom and Lilly. I didn't realize those were in the top 10. Everything else, at the end of last year, Berkshire is bigger than Alphabet. I don't think it is anymore. So a little bit of background. Market consensus suggests that market concentration has accelerated since 2010 and is now at its highest level in history, surpassing the dot-com bubble. You don't remember the dot-com bubble.
I was 5 years old.
Yeah, right. You were very young, but I remember the dot-com bubble, and it seemed at the time that we talked about the concentration. We were floor traders, so we talked about the concentration nonstop. But then when the market turned around and started to sell off, it was a nasty sell-off. The NASDAQ went down by 80%. The NASDAQ composite went from 5,000 to 1,000. It's crazy, over a 2-year period. That's my only real memory of that kind of concentration just imploding. But what does market concentration mean for traders? What does it mean for investors? Let's go to the next slide. So we did a study, and we looked at 1995 to the end of 2023. We used the S&P ETF and all the annual reports. We did the total weight top holdings of the year, and we're going to show the trend of market concentration over time suggests a cyclical nature of concentration expansion. The normal distribution chart that shows we are at an extreme degree of concentration, and I'm going to let you articulate this a little bit in a couple seconds. The duration statistics show a frequent turnover rate among the top 10 holdings. Now, why that's interesting, and we can talk about this in a little articulate on this as well, people don't realize how much disruption actually takes place. And if we look at the top 10 holdings in 2000, I think there's only a couple that are the top 10 holdings in 2020 or 2022 for whatever. So there is a big changeover. Sure. The question is guessing which one of those stocks is going to have the big changeover. So the recent surge to new highs for the last 10, 13 years, market concentration is nonlinear, with fluctuations. So let's talk about kind of where are you going with this slide?
In this slide, we have three plots. So the top 10 holdings in yellow, top 3 holdings in cyan, and top 1 holding in purple. And what you see here is that all these 3 plots, they kind of move in the same directions, but it's not a linear process. So there's up and down. You see, so going back to the earliest of our data, 1995, you see between 1995 to early 2000, there was a surge, and then reaching a peak about, let's say, 25% in the dot-com bubble. And then we know the dot-com bubble market crashed. It crashed all the way to 2008, but the market concentration kind of like declined steadily from 2000 all the way to 2010, 2012. By then, this whole period, market was in a situation of contraction. So the concentration level was declining ever since the dot-com bubble. But then after the about early 2010s, let's say 2011, 2012, you see the speed is picking up again. The last decade, basically the decade of low interest rate, seems like contributing to this resurgence of market concentration, which we're currently sitting at the highest level in some near 30 years.
And that's the real takeaway from here is that we are currently we've seen a surge in the concentration level, and that's the scary part. 5% of the stocks make up.
5% of stock make up 32% of the total weight.
Yeah, I don't remember. Was it only 10 stocks? I don't have to go back and look. So this is one I found really interesting. The current extreme. We are currently in the 100th percentile of market concentration. 100th percentile. We don't get there very often. We're freaks about like IV rank and things like that. And when you get to how do you know when you're at an extreme? Well, when you're in the 100th percentile, you're probably
near an extreme.
You're near an extreme.
Yeah.
Right? I mean, that's the reason you put this up here was to show, where we are, or how do you measure an extreme? When you get to the 100th percentile with respect to market concentration, you're at a level where, okay, you can argue it's an extreme. This gets back to the fact that these companies, there's a rotation and there's disruption. We look at the number of basically, well, why don't you explain this a little bit? Because you wrote it on the right-hand side, stocks come and go, and only 27% have stayed more than 10 years in the top 10, which when you think about it, that would probably be very similar to like sports, very similar to lots of other things. But because people have this crazy misconception that, once a company reaches market cap or success, whatever, that it stays there forever. It's not the case. Over our careers, we've seen like from General Motors to IBM to Intel, Cisco, Lucent, all these companies that have been market leaders that are no longer market leaders. You wrote here 38 stocks have been in the top 10 over the past 28 years. That's a pretty decent sized turnover. So only 2 have been there pretty much the whole time.
Yes, and which 2, if any audience know?
Which 2?
Which 2? It's Microsoft and ExxonMobil. So for somebody who wants to buy a stock for like 2 decades, 3 decades, you have to pick exactly these 2 to consistently win the past 30 years. So
Microsoft and ExxonMobil, would you have known that? I guess I would have guessed Microsoft. I probably would have said Apple too, but 30 years. Yeah, probably.
And I think a lot of your win in the past 30 years with Microsoft has to be recently.
Oh, it's definitely recent.
Because Microsoft was a $40 stock forever.
$65.
Yes,
10 years.
So most of that is in this last decade or so.
Yeah, but it's interesting to see how big so below 10, most of the stocks are below 10 years.
Sure.
That's the point, that these stocks rotate and everything else. That's good. That's really interesting, actually. Most important, diversify your investments. We talk about it all the time on Tasty. Market concentration exposes the market to a one-sided risk posed by heavily weighted stocks. I read somewhere the other day, 90% of Warren Buffett's investments for Berkshire Hathaway are like in less than 5 stocks. And I think that a lot of, these hedge fund managers have the same kind of heavy portfolio concentration. Now, one reason is because there's only so many places you can put that much money. But the other, other reasons are they just don't have that kind of correlation. They are exposed to market concentration and non-correlated. So adjust your portfolio by combining uncorrelated assets to reduce risk. That's one of the advantages that retail investors have. You can reduce risk by using uncorrelated assets. And be proactive with your investments. The majority of the top 10 stocks come and go with a medium duration of just 6 years. Found that very interesting. Stay active and flexible with your choice of underlyings, holding periods, and we need to add to that strategies as well. But that median duration of just 6 years, very surprising to me.
I think a lot of people have this idea that if they really like a stock and the stock is doing well, they can hold it for the rest of their life, for their grandchildren. But if you look at the statistically speaking, you have to be really lucky to pick just that one stock that can do that.
100%.
So basically, our Tasty method of being strategic, being proactive with your strategies and ideas, I think this is the way to go for people, whatever their goal is in investment.